A number of economists believe that the U.S. is already in a recession or soon will be. Today was another bad day for stocks after China warned its neighbors that it would retaliate against them if they struck trade deals with the U.S. at China's expense. And Trump attacked again the Federal Reserve Chairman Powell and indirectly the independence of the Fed. I noted in a comment to my last blog that the significant stock decline today was accompanied by a rise in Treasury yields and a decline in the U.S. dollar's value against a basket of major foreign currencies. As I have discussed in the past, having those three movements occur at the same time is most troubling. I would normally expect on a bad day for stocks for the U.S. dollar to go up in value and Treasury yields, intermediate and longer term Treasury yields, to go down. I would note that it would not take much of an increase in Treasury yields to wipe out and then some the actual spending cuts claimed by Musk and his Doge boys, as distinguished from what they have claimed to have cut. The U.S. debt is currently more than $36.2 trillion. Do the math for a 0.5% increase in the interest cost on an annual basis. For households who are already financially stressed or who have inadequate rainy day funds, now would be a good time, in my opinion, to suspend as much discretionary spending as possible, pay down expensive credit card debt, and build up a financial cushion. These changes are prudent for those households until there's more clarity about the U.S. economy, including the stagflation scenario that is currently a concern of the Federal Reserve Board, as stated recently by Chairman Powell, and that angered Trump to no end. The abrupt and substantial increases in tariffs will cause massive disruptions in the U.S. supply chain and will be inflationary. And it was the disruption in supply chains that was a major cause of the problematic inflation during 2021 and 2022. Also, many small businesses lack the capital to pay the U.S. tariffs as they've been dramatically increased, and consequently will lose products or components that they need to survive and prosper as businesses. Many will end up declaring bankruptcy. All product shipments from China are subject to the 145% U.S. tariff taxes or higher will stop or slow to a trickle, as well as all products shipped from the U.S. to China. I noted that Ford had suspended its delivery of vehicles to China. According to the Yale Budget Lab, real GDP is estimated to be 1.1 points lower in 2025 due just to the Republican tariff taxes and will be persistently smaller by 0.6% or about $180 billion annually in 2024 dollars. That analysis assumes no additional tariffs and includes a continuation of the carve-out for semiconductors, phones, and other electronic products shipped from China, which are not currently subject to the retaliatory tariffs, but it is my understanding that they are still subject to the first 20% tariff taxes that Trump imposed soon after becoming president. The March consumer spending numbers may be okay, maybe just fine, since so many consumers bought products in advance of the Republican tariff taxes going into effect. That excess in spending, primarily purchases of new cars, will not repeat, and spending numbers into the spring and summer will most likely be much weaker than previously expected. Consumer fears about losing their jobs has risen to levels last seen during the pandemic, and that will restrain consumer spending as well. I bought some senior unsecured bonds today. I've been going out a little further in time. I bought one or two that will mature in 2026 and a Virginia electric power that matured in 2034 or 2035 that had a 5% or higher coupon. I don't remember the exact numbers. And I also bought two of the Duke Energy Progress First Mortgage bonds that have a 5.1% coupon maturing in 2034 at less than par value today. I own several first mortgage bonds from that issuer, which is a wholly owned operating subsidiary of the large utility holding company, Duke Energy, as well as first mortgage bonds issued by other operating companies of Duke Energy. There are several. I'm continuing to buy stocks, and I did today, but the amounts are still irrelevant. The CME FedWatch tool has a 100 basis point decline in the federal funds rate from the current 4.25 to 5% range as the more probable than not scenario. The Fed is in a box now. Republican policies will likely slow growth this year, most likely result in a recession, in my opinion, and increase inflation as well. Stagflation, which is something that I'm concerned about the most, is a likely scenario, and by likely I mean more probable than not within 12 months. I believe that the Fed will cut when the recession indicators are present, even if inflation is moving persistently higher from the current levels, which are still too high above the Fed's target range of 2%. That would be a mistake, in my opinion. Problematic inflation will cause more serious problems than a 2 or 3% rise in unemployment. Unemployment which may occur by the first half of 2026 or sooner. I would note in passing that a technical analyst asserted earlier today that two weekly closes below 51.26 to 51.33 in the S&P 500 would breach her technical support line with a downside risk then to 4,500. Intraday, the S&P fell below that range, hitting 51.01 as a low, but managed to rally in the last hour to close at 51.58.2, down 124.5 or 2.36%, or about 1,000 points below the all-time high hit in mid-February 2025. She mentioned Fibonacci numbers to support this claim of support. Whenever I hear that name, what comes to mind is witchcraft. I cannot help but think of witchcraft and Fibonacci in the same thought. I will link her interview in the more section below. The market's internals are awful, but you don't need a technical analyst to tell you that. There has been a death cross in that index where the 50-day SMA line has gone below the 200-day SMA line. I do believe there is a danger that is building of another leg down, a significant one, but that may need some catalyst like Trump firing Powell and installing somebody like Pete Hegseth as the new Federal Reserve Chairman, or some kind of economic data pointing to the stagflation actually coming about. And a number of stocks that have led the market higher still have a lot of fluff in them and are priced even after correcting for a very optimistic future scenario in terms of revenue and earnings. And so they could continue to lead the market down for a while if you get some catalyst that causes investors to become worried about their profits in those stocks evaporating and turning even negative.